Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was watching on YouTube Dave Ramsey, and he was suggesting to pay off your mortgage as quickly as possible and then start to invest afterwards. And I was thinking and doing some research on it, and I already know my answer, but I was just trying to figure out and understand maybe his point of view when he always refers to this is what millionaires have done. So he has all this data. He's got a bunch of millionaires that he has obtained information from. And he said, well, this is the quickest path for those people to become millionaires. And what they almost all did was they paid off their mortgage as quickly as possible. But here's the problem. Most of those people are older. They're 50, 60, 70 years old. And they lived through a time frame where interest rates were much higher. So I don't know if the data that he has can be projected in market conditions today. Now, I think there's a lot of merit in a lot of the things that he says. I think there's a lot of merit in paying down debt, not having debt. I understand that. But the reason people, even like myself, like my brother, like my parents, you start looking at the data and you start looking at different approaches. There was a game we played, and this was back all the way in ninth grade. I know this is weird, and there's only one thing that stuck with it. We were playing this game, and had this like a city that we had built, and we all had different jobs within this society that was created. It was just a test society, so to speak. And the one thing that I walked away with, just the one thing, that's all I walked away with, was one thing. You don't want to spend all your money and go to a very low amount. You'd be better off having some debt, but keeping a lot of cash in case a rainy day comes. So the name of the game isn't necessarily to be debt free, even though that's really positive. The name of the game is to keep the game going as long as possible. And that stuck with me because we basically ran out of money, and we were a utility. And you can't really, like, once everybody got their utilities hooked up, which was an initial charge, then you had recurring charges after, but they were much, much smaller. So, and I know this game wasn't necessarily, I would say, a correct application to real life, but it was, I would say, pretty close. But the problem that we ran into, and this was ninth grade, and I didn't have much experience with dealing, managing and budgeting things. But it was being able to play the game. And in order to play the game, you have to have liquidity. And in order to have liquidity, you have to look at it from a way that you keep your liquidity position strong. Now, in this particular game, we had to buy like a car, we had to buy this, we had to buy that. And, it's, in my opinion, it would be better to take a loan and be in the game longer than it would be to try to buy everything in cash. That was our problem. And it was me and another person. We were paired up, and we were making decisions on how we could play this game. Now, I'm not saying that, you want to go leverage up, but if you have an interest rate like I do at 2.75% on a 30-year loan, and I pushed my expenses to as low as possible to lock in a very low expense or cost, and your inflation rate is greater than your interest rate by a good margin, why would you pay it off early? The benefactor of that would be the banks, because they want you to pay off the loan as quickly as possible to obtain their money back in a real negative rate interest rate environment. So I don't understand why someone would pay it off as quickly as possible in a real negative rate society or world. And especially if this real negative rate is going to last for a good long time. At least I think it's going to. Probably at least 10 years, 8 to 10 years. So that I don't understand, but I understood that it's better to have a bunch of liquidity. It's better to be able to tap a bunch of different things in life than it is to run low cash levels but be debt free. And that, obviously, you can build those cash levels faster, not being debt free. But I still have a mortgage. I'm just going to let it. I'm going to pay the minimum. I'm going to throw it out as far as I can and let inflation eat it away. That's my strategy. Doesn't mean it's right for everybody. And what I do is I save and invest lots of money. And if I had a problem, I could pay the house off immediately. There's no point of me to be scared of debt. I'm not scared of debt. I could pay it off today and still be fine. Now, why would I pay it off if we have the largest commodity boom in front of us? Why not just invest in assets and invest in low risk? And the way that I did it is I have more money in precious metals than I do in my house, and that I owe in my house, I should say. And I'm playing this, I think, the most responsible way. So if I were a data point for Dave Ramsey, under these conditions coming from me, I'm not going to pay it off early. My brother, on the other hand, he refinanced to a 15-year loan, and he is going to try to pay it off early. And there's other people I know that want to pay it off early. They want to pay it off before they retire. And it's not necessarily because of any other measurement that you can do. It's more psychological than it is mathematical and logical. But I was reading through this. Here it says in the article, do we pay off the mortgage early? It seems to be a never-ending debate among many in the financial community about whether or not you should pay off your mortgage early. And there's others who think you should pay off the mortgage as soon as you can. That's the Dave Ramsey type. He recommends people take a 15-year mortgage and is no more than a quarter of their take-home pay. The other person, Rick Eidelman, one of our leading financial voices in America, believes you should obtain as big of a mortgage as you can afford and take the money you would use to pay off the mortgage and invest it. His advice can make a lot of sense if your mortgage interest is at 4% or less, then you can most likely find investments where you'll obtain a much better rate of return. Since mathematically, Ramsey's advice may not make most sense, but as he and others note, there's a true psychological advantage to having no mortgage and no debt whatsoever. You lower your risk and you lower your stress over money as well. Both positions have their advantages and benefits. So I have a 2.75 fixed rate 30-year loan, and I am not paying it off early. I am maximizing my liquid positions over time. And if I decide to pay it off early, I can do that if I want to. It says, how do you decide what's best for you? In order to determine whether or not you should pay off your mortgage first or invest, you need to ask yourself a series of questions. Here's the questions you need to ask yourself. What is your attitudes about debt? Are you comfortable with it? Do you hate it? What is your time horizon for retirement? If you're close to retirement and haven't saved anything, but you're close to paying off your mortgage, you might want to ramp up retirement savings. What does your current financial situation look like? Are you a disciplined investor? Can you be disciplined enough to take extra money, put it into investments, and leave it for the long-term financial planning? Answers to some of these questions can help you decide your own answer. And this is this person's basic rules of thumb to live by. First, pay off your debt before you retire. Second, save at least 15% of your income no matter what. Third, don't buy more house than you can afford. Finally, determine what your financial goals are. And strategies for paying off. First, switch to bi-weekly mortgage payments. Second, refinance your mortgage. Third, throw a little extra money in on your mortgage. And finally, allocate future dollars to mortgage payments. And I was just kind of looking at this, and I don't really have too much else to talk about with respect to other, things. One of the things that I should have done, looking back, is I bought a condo at the bottom of 2009 for super cheap. It was foreclosed, bank owned, super cheap. It was like $100 grand, and I could have refinanced that, and my mortgage payments would be $200 a month. There was a homeowners association fee that had utilities and everything tied into it. Internet was tied into it, just absolutely everything. About $400. So I had, and then taxes, I'd say were probably about $200 a month. So it'd be 400 plus 400, about 800 a month for that place. It's a 1,200 square foot place, 1 bedroom, and I could have easily rented that out, easily. And now the rent, it's probably 1,800, 2,000, something like that. I could have easily made a bunch of money, a cash flow on that, at least $1,000 a month. And I bought it at the bottom of the market for, I think it was $106,000. And right now it's going for probably 270 or something like that. And there's another one that I could have bought, another apartment condo. I lived in it for a little while. I rented for a bit when I first moved to Colorado. The person who owned it offered it to me for 165. I wanted to buy it. My wife didn't want to buy it, but and I understand her side. She wanted to move into a house. I wanted to buy it and buy a house, but it would have been better if I bought that and just held on to it. I did not know the real estate cycle at that time. Didn't know where we were located for either of those purchases. And if I had known that, I would have kept on, kept those on. That one would have went from 165, and I think it's 375 right now. That would have been a big, big one. So I could have made lots of money on both of them, and I could have rented them out and cash flowed them massively, absolutely massively, and refinanced at very low rates. And I wouldn't be that leveraged even. And I'd have all this inflation and rent prices going up. Yeah, it would have been a huge win, huge, huge win. So real estate is an important aspect to gaining and obtaining wealth. You just have to know the real estate cycle. And the real estate cycle is really easy. And the real estate market is pretty steady. You don't get the fluctuations like the stock market does. It's pretty steady. It's pretty, you can put in sweat equity to it. There's a lot of things that you can do that are within your control to add value to the place. And I think that's much less so in the stock market. So looking back, I should have had a lot more real estate. I should have never sold either one of those places. But I was a pretty young person at that time, especially I was 27 or 8, 26 when I bought it was 2009. I'd be 28 when I bought the condo. So just looking back and the things that I should have done, I should have held on longer for basically everything, for a lot of the investments during that time frame. And I remember, I didn't know what I know now. I did not know that. So I can't hold myself accountable. I was trying to learn it. And a lot of the information that I was listening to, I think, wasn't necessarily correct. So, I mean, looking back, I should have kept those places. I should have left my investments also in the companies that I had, like Chipotle, Visa, MasterCard. I still own some in United Health Group, Anthem. And someone asked, how did I pick those companies? What did I do? Guys, there's nothing huge to it. Just pick companies that you see that are growing. Chick-fil-A would be a really good one. That would be an awesome company to invest in if it were public. It's not public. It's private. But I just saw these growing, and I went to Chipotle. I liked their food, and I was like, dude, they're going to kill it. That was back in 2004. And then they went public in 2006. I bought it right when they went public, and then I wrote it for a little while. Made some money, but not much. And I should have held it the entire time. So just finding companies, and United Health Group, they're headquartered right where I lived in Minnesota. Anthem, which is Blue Cross Blue Shield, that was one that I picked up on. That's our company had that as a health insurance, and it seemed like they were raking it in. That's for sure. And it's just stuff that I thought was obvious and easy. MasterCard was another one that I owned, and Visa. And then Google. I owned Google because everybody uses Google. And I just bought everything that everybody was using. And I was making a bunch of money, and for part of it, I put that in a 401k. And then they sold my 401k in 2012. And I had an all-star portfolio at that time. It was awesome. So really, it was just holding longer, identifying where you should be during certain market cycles. And right now, we should be in commodities. That's what it should say. That's what it's saying. And the thing about commodities is they are far more leveraged and a lot more volatile than all of the other areas. So if you can master this area and you can ride through it, then you'll be fine for all the other areas because they're not nearly as volatile. So, I mean, that's what I've got. That's what I wanted to share. And I'm not paying my mortgage off. I'm actually maximizing my liquidity and investment positions. So I've got lots of stock, lots of physical precious metals. I have health savings accounts, 401ks, Roth IRAs. I have all this stuff, and I'm really beefing them up. That's what my goal is, to hit these way up there, to get the values way up there, and I don't really have to worry about finances at all. And that's what my goal has been. Now, there's been a lot of setbacks going away with, I've had kids, and kids have had to have surgeries and all sorts of stuff, and I've paid a lot of money for all of that stuff, probably 50,000 at least, over all the years, 60,000, with all these high deductible garbage health insurance plans. But I think that's all behind me now. Hopefully, fingers crossed. So yeah, that's what I would have done differently, and maybe you guys can use this for whatever you want. But I just didn't hold long enough, and I didn't recognize where I was in the cycles. You have to do that. If you can recognize where you are in the cycles, then you can maintain that viewpoint. If you look at it from a 10-year investment, you'll do fine. If you get scared because of the market fluctuations, then I don't think you're going to make nearly as much money. You have to stick with it, and you can't be persuaded or dissuaded out of things. And Chipotle even had pretty big moves as it went through, but they were buying opportunities, not selling opportunities, so long that the market conditions are ripe for that investment to do well in. So that is the largest, most important thing, is to identify the cycles. Identify the cycles. And to hold through you have to condition yourself to hold through the entire cycle. That's how you make, by far, the most amount of money with the least amount of risk. Short-term trading will not get you there, I don't think. You're not going to make 20, 30, 40, 50 baggers. Mm-mm. And if you're going to choose regular companies, just choose the stuff that's obvious. You don't have to speculate too much. If you see something growing, just get in early. If you're at Walmart and you see Roku TVs coming out super early, go buy some Roku. Like it's that easy. You can look at the financials, but the financials don't necessarily mean that it's a good or bad company. You have to also look forward and say, hey, look, this growth is going to be so ridiculous that they're going to be profitable at some point here, shortly. But that's all I've got, guys. Give me a thumbs up. Subscribe to the channel if you haven't. If you like what you're hearing, join and become a platinum member on the Finding Value website. It's in the description link. Check it out. And I go over all these cycles. There's a bunch of financial education. I'll be doing a training session here on more technical analysis type stuff. And again, I use technical analysis for entry points. That's all I use it for. And then I hold on for the rest, for the entire bull market. That's my strategy. And that's all I've got, guys. So we'll catch you next time. This is Finding Value.